Imagine learning a skill that can make you an extra $10,000, $20,000, maybe even $30,000 a month from the comfort of your own home without ever having to break a sweat. And if you don't know me, I know what you're thinking. You're probably telling yourself right now,
this guy is a scammer.
I want to introduce myself to you. My name is Alden Kupferberg. I'm Senior Vice President at Stratton Oakmont.
But I'm not. I promise you, I'm not trying to sell you a course. I'm not trying to sell you a book. I don't even want your email address. I just want to help you stack up your chips, baby. So if you're ready to make some extra cash every week, all I ask of you is to please smash the thumbs up button so the YouTube algorithm can help get this video to the people who need it. And if you're not subscribed to the channel, then hit that little red button and join me on this journey because we're gonna make some money in the stock market on this channel. And learning this skill will benefit everyone. So with all that said, let's get into the video. What's up guys? Welcome back to the channel. My name is Johan Lorenzo and this is not financial advice. In today's video, I'm going to give you guys an insight on how I make fast, consistent money in the stock market through the simplest, easiest option strategy there is in the world. With this strategy, I get paid thousands of dollars monthly to buy stocks at a discount. I'm dead serious. This is not going to be a full-blown options course, but I am going to give you the basics on what you need to know in order to understand and execute this strategy on your own. And also, if you're new to options and you don't have a Robinhood account, I highly recommend and suggest you open one up. I'll leave a link down in the description below for you guys to open the account. It is completely free of charge and Robinhood is a very good platform to learn how to navigate options trading. It is very easy and simple to get in and out of trades, especially when you're in a hurry and you're a newcomer to this. The app is very user-friendly, and once you get good with the verbiage and all of the moving parts of an options trade, you can trade options wherever you want. But for selling options, I personally love the platform. So moving on, the option strategy that made me $3,770 profit in a single week is called a cash secured put. To execute a cash secured put, you have to sell a put option. When selling a put option, you're basically saying, I will buy 100 shares of this stock by this date if the stock goes below this price, and that is your strike price. And there are a bunch of different stocks that you can do this with for all types of portfolio sizes. And before the video's over, I'll give you guys a list of companies I've been doing this with over the last few months. Let's take a look at the one I just recently did on Friday, July 23rd. So as you can see, this account is just over $181,000, and by the end of the week, it should be up a few grand after this trade. So we're gonna click on Tesla here, and at the bottom right, we're gonna click on trade and then trade options. Now on the top, we're gonna pick the expiration date, which I'm gonna go for July 30th, which is 1 week out. Then I'm gonna make sure I click on sell and put because I'm selling a put here. I am not buying a put. That would be the complete opposite of what I'm doing. So always make sure you have clicked sell and put when selling a put option. So now we have to pick a strike price. All right, so here I'm gonna enter the amount of contracts. So if I'm planning on buying 200 shares, I need to enter 2 contracts because each options contract controls 100 shares of the stock. Now I'm going to enter the limit price, which is the price I will be getting paid per contract. I'm going to put it somewhere in between the bid and the ask price so I can get my order filled pretty quick here. So let's go with $18.85 per contract. Now I'm going to click review, make sure my order is good to go, and swipe up to execute the order. Alright, so as you can see, the order went through and both of our contracts are filled for a grand total of $3,770. That is what is called the premium. We just collected $3,770 to give someone the right, but not the obligation, to sell their shares to us if Tesla happens to fall below $635 per share. So let's go back to the main screen where you will see your cash secured put under where it says options. When you click on it, it will show you all of the details of your options play. So taking a closer look at the details of your position with the option trade, you can see on the top left it says -2. That is because you sold 2 contracts, meaning you would have to buy 200 shares if it goes below the strike price, which once again, the strike price here is the price I feel comfortable buying the shares at. So in this scenario, I chose the strike price of $635. Tesla was at around $645, so the premium was pretty good when I sold this option because the price was relatively close. If I would have chose a $600 strike price, I would have collected much less premium because the price is further away from the current price of the stock. Now looking at the details again, as you can see, it shows your expiration date, which is the last day the contract will be valid. Then you can see the average credit, which that's the price I collected for each contract. Remember, you have to multiply this number by 100. So I'm really collecting $1,885 per contract. So you multiply that by 2 contracts and that's how I collected $3,770. Okay, this part here towards the bottom where it says today's return and total return, it shows I'm negative right now and I'm down on the option. I'm not really losing money though. This is just telling me there are other people currently selling the same exact option and they're collecting more money because the stock price is bouncing around. And that's fine, that's volatility doing its job. I'm still going to collect my $3,770 regardless of what happens with this options contract. And now I'm going to show you guys a screenshot of how the contract starts to lose value with each passing day. This screenshot was from Thursday, one day before the option contract expired. So as you can see here, on the bottom, my total return is 98.67%. I basically collected most of my premium, and if I wanted to get out of this position and not hold it any longer, all I have to do is buy back this contract and I'm out of the play. As you can see on the left-hand side where it says current price, this contract has been eaten away by theta, which is the term used to describe the time decay on an options contract. I'll explain that in further detail in another video, but for now, just know that theta really benefits the option seller and it works against the option buyer. This is why I love this strategy so much. The worst case scenario for me here is I'm buying shares of Tesla and I'm buying them for a discount, and actually an even bigger discount because I collected the premium also. So what I could do is I'll wait for a bounce, or I can sell another type of option and make money on the shares that way. I'll show you guys that option play in another video. If you're an options buyer, it's a completely different story. The $3,770 I made this week from this play, someone else lost it. They bought the contracts and theta ate away the value of their contracts and they expired worthless. That guy or gal has nothing to show for this options play but a deficit in their account. Here are the other stocks you can do this strategy with, like Uber for example. Uber's trading around 44 bucks. You can sell a put option for the end of the week at 42 bucks and collect $1.04 in premium, which is the number shown on the right hand side of the screen here. Remember, it shows $1.04, but you have to multiply that by 100 because the contract controls 100 shares, which means you're really making 104 bucks for the week. So in order to sell a put option for Uber at $42, you'll need to have $4,200 as buying power in order to sell the put option. That's the money your broker will set aside and hold for you in case Uber drops below $42 and you get assigned the shares, meaning you'll be obligated to buy them. That is the responsibility of being an option seller. That's why you're collecting a fee. You're basically giving someone the rights to make you buy the shares from them if they drop below that strike price. It's still a win-win in my opinion though. You're exchanging your money for shares of a company which will still have intrinsic value and they could still bounce in the future. Unlike buying the options and losing your money, you're out of your money and you have nothing to show for it. In this scenario, you would still have the shares to show for it. So here's another quick note. The further you set your expiration date, the more premium you're gonna collect because the stock has more time to move in either direction. I don't really recommend going too far out with your expiration date. I prefer 1 to 2 week expiration date for the most part. But sometimes I will do a month out depending on the circumstances. Another stock you can do this with is NEO, Carnival Cruise, ticker symbol CCL, and Palantir, ticker symbol PLTR. Those are 3 other stocks that I've done in the past. So there are 3 very important key points to remember here. If you want to be really successful doing this strategy, you guys need to pay close attention and either write this down or take a picture of the notes I'm going to show you here on the screen because this will save you a ton of headaches in the future. Number 1. Never do this strategy with a stock you're not willing to hold long term. The stock market can be very volatile, and in the short term, things can get ugly very, very fast. So when you're planning on doing this strategy, make sure you're doing it with a stock that you believe in for the long term, and you don't mind holding it for a while if the stock market crashes. The stocks that I really like to do this with are AMD, Apple, Facebook, and my favorite of all, Tesla. I don't mind holding any one of these companies for several years if I had to. If the stock market crashes and I had to hold these companies for months and months, I'm perfectly fine with that. Then we're coming on to number 2. Pick a strike price that you're comfortable owning the stock at. The wonderful thing about selling put options is you get to pick the price in which you're willing to buy the stock. Let's use Tesla for example. If Tesla's trading at $670 and I want to buy shares but at a cheaper price, I will sell a put option at a price that I feel comfortable owning the shares at. So I would pick a price around the range of $635. Not only does it give me an opportunity to buy the shares for a cheaper price, but it also gives me the opportunity to collect a premium that comes with the options contract. And if Tesla doesn't come down to $635 a share, guess what? I keep the $1,885 and keep it moving. Regardless of what happens, you always keep the premium with this strategy. So this brings us to number 3. Or in the words of my Jamaicans, yeah man, ya done on number 3 man. But in all seriousness, number 3, never ever sacrifice the strike price for premium. Do not get greedy. I'm gonna say this again. Do not get greedy because it can bite you in the butt in the long run. When you're selling a put option, pick the price that you're willing to pay and own the shares for. So what I'll do is this. I'll look at the chart, I'll see how the stock has been trading for the past 3 months or so, and I'll make my best educated guess based on the trend of the stock. I'll then pick my strike price based on how the stock has been trading. And I'll usually go 1 to 2 weeks out for the expiration date. That's how I do it. If I like the premium being paid and I want to get a position going with that stock, I'll write up the contract, I'll place the order, and that's it. But remember this, do not fall into the trap of trying to get more premium by sacrificing your strike price. Stay true to yourself and pick the price that you feel comfortable owning the stock at. And if that price happens to have a fat premium, then... So let's talk about some of the potential downsides to this strategy, which in my opinion, they're not really downsides, but we're gonna mention them anyway. Like in the scenario with Tesla, if Tesla were to take a huge dip and come down to $600 a share, guess what? I'm gonna be stuck paying $635 per share because that's the strike price I chose to sell my contract, and that is called assignment. You gotta sign the shares because they went below your strike price, and in this case, it is $635 per share. So technically, I would be paying $35 overpriced, but remember, I also collected a premium that offsets that loss. And this can happen if you're buying the shares straight up also. If I would have bought the shares at $650 straight up, I wouldn't have collected any premium and I would still be down $50 per share. So it's really not the worst thing in the world, but you know what they say, hindsight is 20/20. And another potential downside of this strategy is all these gains that you make through options trading, they're taxed at your regular income tax rate. So you don't really get much of a break when it comes to taxes. But guess what? As long as the outcome is income, what are we talking about, man? You're still making money. Come on now. If you don't have the money to sell a put option because it does control 100 shares, so you need to have enough cash set aside to purchase 100 shares, I'm gonna show you guys how you can buy shares little by little, and then you can lease out those shares per se and collect money for owning those shares. So on a lot of these companies that they don't give a dividend, like AMD, Facebook, for example, I make my own dividend. In my Charles Schwab account, I sell covered calls on these stocks, and I basically make my own dividend every week or two. Now, you cannot sell a covered call if you're married to the stock. If you really like that stock, do not sell a covered call. And I don't recommend selling covered calls on any dividend stock where you don't want to let go of because you might end up selling them. That's called assignment, but that's for a whole nother video. Back to the point. So with this strategy, you can increase your weekly and monthly cash flow, giving you more money to stuff into your dividend portfolio. It's really a win-win in my opinion. You're generating profits through what I believe is the safest way to trade options, and you're putting those profits to earn you even more money through dividend growth investing. You can already imagine how quickly you can begin to compound your money by doing this together. I hope this video brought you some knowledge on how you can increase your monthly cash flow by trading options and how hopefully it can help you grow your dividend portfolio that much faster. Don't forget to like this video and don't forget to subscribe to the channel if you haven't. I want to thank you all so much for watching and I'll catch you on the next one. Peace!